Alrighty, looks like we are live. So welcome to another Properties and Beers. I know it's not a Friday, it's a weekend, but just for you, I'm going to do something special. We're actually going to start off by making a cocktail. Even before I get started on Properties and Beers, let's make something special. So I felt today like we deserved a espresso martini. So we have some cold brew straight from Bali. No, I'm not in Bali, but let's add all these ingredients together in our little shaker and give it a good shake. And then we have, of course, some coffee liqueur, Kahlua. This is the salted caramel special edition. And there you go. And then, last but not least, some of this stuff. Belvedere vodka, always good. Now, if you're watching this and you're like, what the hell's he doing? So I'm making a espresso martini. So the three ingredients, for those that don't know, that constitute an espresso martini is coffee, a coffee liqueur such as Kahlua, and vodka. So give it a good shake. Now, we won't just drink it now. There will be a special way I drink it, but it's good to give it a good shake to get some of these ingredients together. So let's get started. You ever get the feeling that the market looks like it's slowing down, but somehow everything is getting more expensive, right? Because that's where things are right now, right? On the surface, it looks like things are easing. Underneath, this pressure building in a different way. And a big part of that comes back to what's happening globally, particularly around fuel supply and the energy coming out of the Middle East. So we're going to walk through that tonight, and we're going to keep it grounded and focused to what's actually happening and how those shifts tend to flow through property. Because when fuel starts moving, you'll begin to see the effects show up across transport, construction materials, and eventually, yes, the property market itself. So, for those that don't know me, my name's Gaurav Gupta, CEO and founder of Ethical Property Investments. We work with everyday Aussies, people just like you, getting on with life, helping them invest in properties that generate strong cash flow while also providing housing that actually fits how people live today. What a concept, right? So tonight we're going to go through three things. What's really happening in the market right now, especially with the fuel supply issues. Number two, how policy changes could shape supply. And number three, why some investors are starting to look like strategies like co-living and STI a little bit differently. So before we get started, this is Properties and Views. Let's continue our cocktail. Those that are just joining this espresso martini. Now, I don't have a martini cup, but I've got my trusty Spider-Man cup with some extra ice because, hey, I'm making this at home, so I can do whatever I want with this. People do different things with this. Here it is, and we then have to add, to finish off, 3 beans for health, wealth, and the last one for happiness. And that, my friends, is an espresso martini. Cheers. Perfect. Now, some people add sugar syrup to it. I'm not a huge fan of sweet stuff. I'm sweet enough as it is, as I like to keep telling the baristas. They don't believe me, but perfect. Not too sweet, not too much coffee. It's right in the middle. So now, there's been a lot of noise lately around forecasts being revised down, growth expectations easing, talk around things flattening out for a while, and on the surface, it kind of makes sense. But here's the thing, inflation hasn't really disappeared. Borrowing capacity, especially with the last rate rise, has gotten tighter than what people were used to. So naturally, it starts to weigh in on demand. People take more time, they're more cautious. Some actually choose to step back and wait. And when borrowing power tightens, you'll see fewer people choosing to stretch and more people hesitating and more people going, hey, I'm just going to sit it out. I'm going to be on the fence and watch it from the sidelines. And that, my friends, is the idea that feeds the idea that the market's cooling, right? But what's interesting is that it's not moving as one clean, uniform market. Some parts of markets are, holding up better than others. You've got a two-step market, and some parts feel a bit heavier, and that usually comes back to affordability pressure. So, there's another layer sitting underneath all of this. And while demand's been adjusting, there's been a movement happening on the supply side of things. Oh, now, just bear with me. I realize I'm not in the right section for comments. So if you've got a comment, drop me a line. Right. And look, as I said, while demand's been adjusting, there's a movement happening on the supply side that's easier to miss if you're only going to look at the headlines. And this is where things start to take a different shape. So we've seen this before. Back around 2021 to 2023, construction costs moved faster than people expected. Materials lifted, trades became more expensive, timelines became stretched out. In fact, builders weren't able to hold on to things, so some of them started going bust, right? Because they'd signed contracts where cost of materials and labor were a lot less, and those things started to grow. And look, a lot of people thought at the time things would settle back, so they waited. They came back to the same projects. The plans hadn't changed, but the price attached to those damn plans had, right? So we're talking, higher cost levels than anything largely held from there. I mean, I saw people who literally within a few years were able to double their property value, and while their friends sat it on top line, and now their friends are coming back to me, hey, Cora, can you do the same deal for me again? I can't, right? And that's the thing. What we saw in 21 to 23, we're starting to see that same thing again. And look, fuel's a big part of that. There's been a disruption around the key energy supply routes to the Middle East. You know what we're talking about, the Hormuz Strait, and all the major shipping channels. So that region, whether we like it or not, it affects what happens globally in the global oil movement. So when there's interruptions, the effects tend to ripple out fairly quickly, and we rely on imported fuel. I know only 20% is from that region, but here's the thing: it's affected supply of materials from that region. So we're talking about a change in global supply, and we're seeing these show up locally, as you know, right? Without much delay. In fact, I would go as far as say some of these oil companies have been taking advantage of the situation and raising up the oil prices much more quicker than they should have, right? So as the fuel costs are shifting, those chains are beginning to work through their way through the system because transport becomes more expensive, shipping costs lifts, materials begin to move, and materials begin to cost more to move and also more to create, and trades begin adjusting the pricing. Those that don't know, for example, a PVC pipe in a house is made from oil, right? It doesn't get made here, it gets made overseas, but that still gets affected from oil. So that movement usually builds gradually, and like, at first it's subtle, then over time it becomes more visible across the entire process. But here's the thing, right? We're starting to see signals much sooner than that because the industry has seen what happened 21 to 23, and they're basically saying, you know, all this together is starting to add all the weight underneath the surface, and it becomes when it becomes tangible, we're seeing it in active projects. Literally, suppliers next month are adjusting the pricing in some cases really sharply. We've seen steel windows come through with increases around 15%. Yes, 15%. Someone's making a good profit there. I'm not gonna say anything. Like literally, steel suppliers have said, okay, we're gonna raise the price by 15% off materials, and this goes across a number of bills. And here's the thing: if you're sitting on the sidelines going, "I'm going to wait till this whole war situation blows over," you know what? In the next month or two, expect all build prices to go up between 5 to 10%. So if you're going to wait, sit and wait, just realize there's an opportunity cost of 5 to 10% to sit and wait. And these shifts are already being factored into the real builds right now. So look at both sides. Yes, demand's eased a little, and the cost of delivering new stock has moved higher. Both these dynamics are sitting in the same market at the same time. But when things come back, when uh, things come back, you'll find that they come back with a bam. So the smart investors invest in 2021. That's what I'm saying. The smart investors are also going to invest now because while construction's slow and supply's tightening, and the supply tightening, existing properties find a level of support where they grow from, and that replacement cost goes up and rises. And people are like, well, is replacement cost like important? That's a really important factor to focus on, replacement costs. Right? I'm trying to get this camera in the right direction. It's got this autofocus thing, right? When you try to bring new stock to the market, it gradually feeds through the broader market. And look, pricing doesn't always move when people expect, the way people expect. And to be fair, hesitation people are feeling right now is understandable. Rates are still higher than what they're comfortable with, right? Now, if we go back to I was doing it the other day. It was mid 2000s where we've had rates higher than what they are now, and we've had a war start and oil pressures happen, and global uncertainty. Things don't feel predictable. The environment keeps shifting, right? We're talking about supply situations, conditions continuing to evolve, and when you look at the pattern, all this tends to lead to higher property prices, right? This pressure carries through the market in different ways. And so where things might feel softer at the surface, the cost pressures build underneath, and you have potential policy changes that are stacking on top of it. And that's where the picture starts to shift further. And I'll cover potential policy changes in just a moment. So, guys, I need a sip. So, let's chat about taxes, right? One of the things I love talking about, especially over the last couple of weeks, and you noticed a couple of weeks ago, I talked about potential changes to negative gearing and capital gains tax, and especially CGT starting to come back into conversation again. So I want to spend a bit more time on it, especially when you look at alongside what we covered on last few properties and beers. And those that aren't aware, please check out the properties and beers again. I've got some stats here I want to run through. Right, so there was a study done by Quave and Tulipwood Economics. I don't know how you pronounce the first one, but yeah, that basically those organizations got together and they did a study, and I want to talk about some of the really interesting stats they had around negative gearing and minimal grandfathering. So what they did, negative gearing and grandfathering and CGT and grandfathering, all of that, right? And I'm sure the team in post-production in a reel will post all this up. So number one, if you remove all negative gearing with zero grandfathering, we're talking, get this, 45,000 less builds by 2030. And by the way, all these stats are by 2030, 4,200 less jobs, and a GDP loss of at least $3 billion. That's right, $3.1 billion. What happens when you remove negative gearing and minimal grandfathering? And I'll talk about why these things happen. If you remove CGT, right, discount, and no grandfathering, we're talking $2.2 billion in loss and a 3,100 jobs lost. Right. And if you're going to restrict negative gearing to one dwelling, you're still going to lose $614 million of taxes, right? So the government's like, oh, we're going to use this to make more money. I'm sorry, you're not going to make more money. You're actually going to lose. It's the opposite way, right? And if you're going to restrict negative gearing to new dwellings and full grandfathering, you're still going to lose $1.5 billion in taxes. So the whole argument around this whole thing is going to pay for more taxes, you remove CGT and things like that. And look, I want to talk about the scenario that's being put on the table right now, which is 25% CGT discount, full grandfathering. You're still going to lose $822 million worth of taxes. So it's going to work the opposite end. And there's over 1,100 jobs that are lost, along with 12,000 less homes that will be built. So the whole conversation, oh, this will make housing easier to get into. Bullshit. It'll make housing harder, right? So, and this one scenario, if you're going to have a 25% CGT discount with full grandfathering, restrict negative gearing to single home with no grandfathering, and that's what they're talking about right now, being the most likely outcome. You're going to have, we've got here 45,900 less homes, 3.1 billion of dollars worth of taxes lost, and 4,200 or 4,300 jobs less at the very least. Guys, just because it sounds good on the bottom line doesn't mean it's good, right? Now, I want to cover some dot points that I got from the same report. Look, housing needs of almost 1/3 of Australia's residents are met through the rental market, and private landlords provide 6 out of 7 rental dwellings. And here's the thing, right? People are like, oh, more renters should be owners, but not every renter, according to this report, not just me, right? Common sense is ready to become an owner at the given moment. There's the unintended consequence of well-meaning policies to grow the ownership pool by shrinking the rental pool are likely to fall disproportionately on the shoulders of the most vulnerable. That's right. The people that need the rental houses the most are the ones that are least likely to be able to buy when the time's right. You can't say, I'm going to make getting into the market easier in terms of ownership and expecting the people that need the rent the most vulnerable amongst us to be the ones that are going to be able to get into housing. That's just not going to happen, right? It's going to be completely lopsided. The people that were on the verge are the ones that are going to be in there, right? It's accepted that as a matter of economic principle, removing negative gearing CGT discount will raise the user costs for property investors and ultimately lead to the higher market as property investors pass these higher costs on to tenants. That's right. Rents will go up. You remove negative gearing, rents go up. Common sense, right? Those costs are going to be passed on, right? When you look at modeling around these potential changes, the theme that keeps coming up is supply. And there's an expectation that if incentives are reduced or removed, fewer investors will step into new projects. That's the stats. That's what the demand says. That's what the studies say, right? And when fewer investors are involved, some developments don't proceed, some get delayed, others get scaled back or just don't happen at all. And over time, you're going to see that as fewer new dwellings by 2030. We're talking an average of 45,000 new dwellings that are going to show up. And it's not going to happen overnight, but it will happen, as the ad says, right? In a market where supply is already under pressure, even a modest slowdown is going to have a massive impact in the future. And from there, you're going to see the start to flow in the other parts of the system. Construction pipelines start to thin out. Fewer projects mean fewer jobs. And the rental market, when fewer properties are being built, the number of rentals doesn't keep up with demand. They're already not freaking keeping up with demand, right? How is adding more taxes going to help with creating more properties? At the same time, you've got holding costs for investors to remain elevated. So what begins to happen is those pressures gradually increase the rent, and they work their way into rental prices, not as once, but over time it becomes really noticeable. So one of those things where early stages it doesn't feel that dramatic and going, hey, that seems like a good idea because the media spun it that way, but over the long term it's going to have a significant impact on what we do. So be careful when well-meaning and well-intentioned policies around tax. Now guys, I just wanted to also chat about, there's something that has been weighing on me, right? The media spun it going, oh, we should increase negative gearing because we need more taxes and stuff like that. And we'll cover this, right? And I'm seeing my friends talk about it on these WhatsApp groups, right? No, in the short, if you want a way out of the housing crisis, you need to increase stock. Like, it's not rocket science. You don't need to be an economics professor to say, hey, if I want to ease the housing crisis, I'm the Australian government, I need to increase stock. And I will be having a meeting with with certain people in the federal and federal governments and so on and so forth about look at ways we can actually increase the housing supply very soon. So in the short, and I have been having these conversations recently too, right? So in the short term, you're going to see a bit of softness if investment activity slows. There's less competition, fewer buyers in the market. Yeah, it might feel like an opportunity, but when you zoom out, guess what happens? You see the supply side being constrained, and the window tends to be shaped for how long new stock teams can come through. So if fewer properties are being delivered over the next few years, that supply and demand gap's going to crash with each other, and the property prices are going to go up. So funnily enough, if you want your property prices to go up, you start building less property. So, when you're looking at policy changes like removing CGT, removing, negative gearing, all that, it helps to think beyond the immediate future, right? Because the full effect usually plays out over a longer stretch. And I get the arguments from friends. We need to pay taxes to fund hospitals and schools. Yeah, I get it. I've seen it on my WhatsApp groups. You know who I'm talking about, right? But did you know we have the highest amount of bureaucrats in the world per capita? Does it feel like you're being listened to? Like your bureaucrats are really giving you value for money? You want some stats around this, around taxes? $1 trillion of taxes collected in the year 25-26. That's right, 1 trillion. That's what they're projecting to collect. Government spending as a percentage of GDP is some of the highest in the world at 25 to 27%. Right? We're already collecting enough taxes. We're already spending enough through government spending options. I don't know. I don't think raising taxes and actually having less GDP in our economy is going to help out. Like, it just doesn't work that way, right? So when you've got a few things moving together, construction costs moving, potential supply constraining building, policy shaping possibly investor behavior, that's when people start asking a different question. Now you're not the only one asking, going, Gora, what should I buy with all this confusing stuff? Or you also start asking, how should I approach this environment, right? Now, before I go further, I need to continue my espresso martini. I don't know why it doesn't look as foamy on the top as you see those other guys make it, but it tastes just as delicious, if not more. Better watch out. This could be quite strong. So we ran a session on Thursday on co-living, and one of the things that stood out was how many people paused halfway and said, "Hey, I haven't really thought about it this way before." Because when you slow it down and walk it through how it actually works in real life, that conversation really starts to shift. And when you look at how people are living right now, there's been a bit of a shift over time, right? More people are renting for longer. Household structures are changing, and flexibility is becoming more important, especially to the people coming into the country. And hey, basically, if you don't have a family, flexibility becomes really important. For a lot of tenants, the focus is on how manageable life feels week to week. Things like being close to work or study, having bills simplified, being able to move without too much friction because, hey, life changes and shit happens, right? So when you look at co living through that lens, you start seeing where demand's coming from. It's not something that's being forced into the market, square peg, round hole. It's actually something that's being chosen already in different forms. Now, then it comes to how the property is actually set up, right? Where and that, my friends, is where the difference sits. The layout needs to make sense. The shared spaces need to feel usable, not cramped. We're talking about private areas that feel comfortable and functional, and at least having that gap between the community and personal space. And when you consider those elements properly, the experience for the tenants in there becomes a lot smoother. And from an investment point of view, the consistency that happens there leads into a high occupancy, tenant retention, and the overall performance of properties. We also covered, by the way, the areas where we wouldn't invest, the top 5 areas where we would not invest, where co living has, in some cases, over 10% vacancy, right? By the way, most co-living has between 1 to 3% vacancy, just in line with pretty much a regular rental market. It's one of these areas where these design decisions does have an impact over time. And what we're seeing is that more experienced investors, and even in some cases, the beginner investor, taking a closer look at this space and going, "Hey, is this something that I want to look at?" They're looking at it in a measured way, and they're spending their time understanding how demand behaves, what makes a property work long term, where the risks sit if it's not done properly, and there's less rushing and more time spent on planning, getting the design right, and working with people like ourselves. And there's a few others out there as well who see if it holds up beyond the initial stage. Because, like any strategy, the outcome's really heavily influenced by how it's executed. And when you really take a look at everything we've covered, you've got a few forces moving at the same time: cost shifting, supply adjusting, demand evolving. And in that kind of environment, I think it's really important that you've got to approach property completely differently, right? Now, I'm going to continue having a sip. Now, before we wrap up, I think it's worth stepping back for a moment and looking at how all of it fits together. We've started with what's happening in the market right now, how things feel a bit slow on the surface, with borrowing tighter and sentiment more cautious. But when you look underneath that, there's a different kind of pressure living up. Your construction costs start to move again, driven by fuel supply chains, flow-on effects of global disruptions, and you've got population constraints as well. So even though things might feel quieter, the cost of delivering new housing hasn't eased. So if you're reading between the lines, that and we add policy on top of that, and how potential change around negative year in capital gains tax could shape supply over time, with fewer projects moving forward, it flows through the broader housing market. Sorry, there's motorcycles going by, right? We're talking about supplies getting tighter, and that pressure really carrying through into rent and availability. And look, we're talking about moving things into a practical way, how things change, how things shift. And that's what we're doing, things that are high cash flow, because I think that's a way, something, if you build something that's high cash flow, that's good for the market, good for the economy, that'll eventually be good for your bottom line, right? So if you're watching this and read all the way through, there's a chance you've seen the market a bit differently right now. And here's something we've noticed. Some people want more information about the co-living products and the SDA products. If you do, drop me a line and I'll get one of my team members to reach out to say, "Hey, maybe we can give you a recording of the webinar that we did the other day," right? Now, make sure you follow us on Ethical Property Investments on Instagram and Facebook, because we post a link consistently, right? So if you got value from tonight, jump over there to those pages and stay in the loop for what's coming next. So appreciate you being here. We'll catch you on the next one. Guys, cheers and have a fantastic weekend.